Same things happen over and over again. And if you study the patterns of them and then can write down principles for dealing with them well, we dealt with them very well in that financial crisis and in other debt crises, and I wanted to pass that template along.
Ray Dalio, understanding the cycles of history to beat the stock market. Understanding the cycles of history is really important because Ray Dalio says this can help you beat the stock market. Let's start the cycle of history with the post-World War II rise of the American Empire and the US dollar. After the Second World War, the victorious powers, most notably the United States, the United Kingdom and Russia, met to establish the New World Order, as is typical. While the Bretton Woods, Yalta and Potsdam conferences are the most well-known, a number of other events affected the New World Order, including slicing up the world and redefining countries and zones of influence, as well as establishing a new money and credit system. In this version, the world was divided into two groups: capitalist or democratic countries governed by the United States, and communist and autocratic countries controlled by Russia, each with its own monetary system. Germany was divided into two parts, with the West controlled by the United States, the United Kingdom and France, and the East by Russia. Japan was controlled by the United States, whilst China descended into civil war, with the main issue being how to split the wealth between communists and capitalists. Unlike after World War I, when the US opted to remain somewhat isolationist, following World War II, the US assumed primary leadership since it held the majority of economic, geopolitical, and military responsibilities. A capitalist system was followed in the United States. The dollar was linked to gold in the new US-led monetary system, and most other countries' currencies were tied to the dollar as well. Over 40 countries have adopted this technique. Because the United States owned almost 2/3 of the world's gold at the time, and was far more strong economically and militarily than any other country, this monetary system worked well and has survived to the present day. The other countries that were not part of this system, most notably Russia and the countries that were brought into the Soviet Union, as well as the Soviet-controlled satellite countries, were built on a far shakier foundation that eventually collapsed. Unlike after World War I, when the losing countries were saddled with heavy debts, countries under US authority, including the defeated, got massive financial aid from the US through the Marshall Plan. At the same time, the losing countries' currencies and debts were wiped out, and those who held them lost all of their assets. Great Britain was severely in debt as a result of its war borrowings, and the colonial age was drawing to an end, resulting in the disintegration of its empire, which was becoming unprofitable. The US, its allies, and the countries under its control used a traditional capitalist democratic strategy to resource distribution during the post-World War II period. New York rose to prominence as the world's preeminent financial hub, ushering in a new era of large debt and capital markets. This resulted in a 75-year period of relative peace and prosperity, which has taken us to where we are now. In the 1950s and the 1970s, there was a productive debt growth and equity market expansion, which were critical for funding early innovation and development, as is typical of this tranquil and successful stage of the cycle. As a result, too much debt was needed to fund both the war and domestic necessities, a situation known as guns and butter. The US was involved in the Vietnam War and the War on Poverty. Other countries became unduly indebted, and Britain's debt became overly leveraged, resulting in a series of currency devaluations and the breakdown of the Bretton Woods monetary system. Then in 1971, when it became clear that the US didn't have enough gold in the bank to match the gold claims it had issued, the US defaulted on its commitments to deliver gold in exchange for paper dollars, effectively ending the Type II gold-backed monetary system and ushering in a fiat monetary system. This fiat monetary system, as is customary, triggered a surge of massive dollar money and debt creation, resulting in a typical wave of inflation that lasted until 1980 to 1982, causing the worst economic crisis since the Great Depression. 3 more rounds of debt-fueled speculations, booms, and collapses followed. The first was the money and credit expansions of 1982 and 2000, which resulted in the dot-com bubble and the subsequent recession of 2000 to 2001. Second, the money and credit expansion between 2002 and 2007 resulted in a real estate bubble and the Great Recession of 2008. Finally, the money and credit expansion of 2009 to 2019 resulted in an investment bubble that preceded the COVID-19 slump. Each of these cycles drove debt and non-debt obligations to ever higher levels, prompting the post-war Allies' reserve currency central banks to lower interest rates and print massive quantities of money. During economic downturns, wealth, value, and political disparities grew within countries, increasing internal conflict. Many countries were more competitive economically and militarily with the top powers during this rich post-war period. China and a number of other smaller countries, including the Soviet Union, initially used a communist resource allocation system. This method failed to make any of these countries competitive. However, the Soviet Union did develop nuclear weapons in order to become militarily dangerous, and a number of other countries followed suit. Because their use would result in mutually assured devastation, these weapons were never employed. In the face of US President Ronald Reagan's weapons race spending, Russia couldn't afford to fund its empire, economy, and military all at the same time due to its economic problems. In 1991, the Soviet Union disintegrated and communism was abandoned. For the majority of the 1990s, the country's economic system collapsed, causing economic and geopolitical breakdowns. Most communist countries abandoned classic communism between 1980 and 1995, and the world entered a successful phase of globalization and free market capitalism. China grew significantly stronger in most aspects as a result of this shift and the world's simultaneous shift to increasing levels of globalism. At the same time, enhanced information management and artificial intelligence are supplementing human intelligence, and the United States and China are leading the way. Human ingenuity and flexibility have been shown to be the most powerful tools for solving challenges and making progress. Now, that brings us to where we are right now. So talking about our present situation, you must understand why Ray Dalio thinks that the stock market meltdown is actually a fantastic time to invest. On the internet, there's been a lot of talk about a possible stock market crash owing to Russia's invasion of Ukraine. Whilst the United States and its NATO allies are backing war-torn Ukraine and issuing stringent sanctions against Russia, the latter seems undeterred, leading to a chaotic global market. A market downturn, however, might not be altogether awful, depending on your investment approach. The primary goal of investing is to buy low and sell high. In most cases, first-time investors do the exact opposite. When the stock market crashes, people become scared, and new investors may sell their stocks or stay away from the market altogether. Long-term investors, on the other hand, who have a lot of experience riding out the market's highs and lows, frequently perceive a downturn as an opportunity to buy more because they can get the same stock for less money. People have historically made the majority of their money during bear markets, or when the market drops by more than 20%. When the others are selling, they buy. This may appear to be a complex operation that only a seasoned investor can execute, but it's actually fairly simple. Even during a downturn, if you've automated your investing by donating a certain amount every month, you can stick to your plan. If stock prices fall, you will receive more shares for your money. If they rise, your shares will gain money. If you don't have any cash on hand to invest, a market downturn may be a good opportunity to increase your 401k contribution, even if it's only for a short time. It's another technique to profit from decreased stock prices after a crash. Take a tip from more seasoned investors and sell a modest percentage of your well-performing assets during a high market, such as 10 to 15%. Hold onto your cash and reinvest your winnings when the market falls to take advantage of lower-cost shares. According to Ray Dalio, people should consider buying low-cost index funds and holding them instead of picking stocks and trading on a daily basis. This form of the diversified fund is often stable, avoiding the ups and downs that occur with picking individual stocks. According to a 2020 S&P Dow Jones Indices report, passive investment in index funds has outperformed 92% of large cap funds over the past 15 years, outperforming 92% of professionally managed funds. Do you think Ray Dalio's words of wisdom would actually help you achieve greater milestones in your stock market portfolio? Comment below. If you liked our video, subscribe to our channel, hit the like button and turn on the notification bell. Share this video as far as possible because the more you know, the more you grow. Goodbye.